skip ahead here. Number 3. What's number 3?
I'm happy to do this. I'm ready to start investing, but how do I do it? What do I do? How do I think about that? That leads to the third thing that we wish young people know, which we would have figured out even earlier in our financial journey, is that lazy investing is the best investing. Brian, what do you mean when we're talking about lazy investing?
Well, I think that we live in this new modern world where we're trying to gamify everything. You know, we need to have fun. So that's why you see everybody getting distracted by the whole cryptos, the NFTs, and all the stuff there, because it encourages you to look at it every day. That's not actually successful investing. Successful investing is going to be lazy investing, where you set it, forget it, and that automatic, inevitable wealth building process. That's what we want you to focus on.
And so why do we say that? Why do we think? Because you first think, oh, well, no, I hear about Warren Buffett. He's out there, he goes and he picks these companies, and he buys them, and becomes wildly successful. And that's true. Warren Buffett has made a very interesting career buying whole companies, right? That's kind of the thing that he's done a lot of. But when you actually look at the data, when you look at the analytics around investors, we know that according to the SPIVA data from 2021, over the last decade, the last 10 years, 86% of domestic equity funds underperform their index. So these funds that set out and say, our goal in investing is to do better than the index, 86% of them did not beat it. So if there's only a very small portion of managers that can beat the index over the long term, why try to go out and beat the market? Why don't you just try to be the market?
I think it's interesting.
They're not talking about, lazy investing is a weird term. What they're talking about is investing versus speculating. Okay, there are basically 3 types of people in the market. You're either an investor, a speculator, or an arbitrager. Investors are people that invest over long periods of time, right? They don't expect to make a ton of money right away. They expect it to build over a long period. Speculators are people who are speculating on specific investments, thinking they're going to go up dramatically, right? They're higher risk, but they're potentially higher reward. That's what they're talking about when they're talking about the non-lazy investor. It's not really an investor, it's a speculator. And then arbitragers will skip. Go to our pilot. We covered the arbitrage really well. So anyway, here's the difference. A speculator and an investor. I'm a speculator. Lacey's an investor. We both have $100,000. Then we walk into a casino, right? And I take my $100,000 and I start playing blackjack and craps and, roulette or whatever, right? Now, I could potentially make a lot of money if I win, right? But I could also potentially lose a good chunk of my money, right? And, in all likelihood in a casino I will, but Lacey, on the other hand, says, you know what? Forget that. And she's like, I want to go talk to the owners. And she goes and talks to the owners, and she says, I want to invest my $100,000 in your casino for whatever, 1%. So now Lacey's a 1% owner of the casino. So she's getting 1% of whatever the profits are every year. That would be investing. She's pretty much always going to make some money. That's what they're talking about. Now, what they're missing here is this concept is efficient market theory. If you're putting your money in the market over a long period of time, the market generally goes up. That's the theory behind efficient market theory. When we did a bit about random walk and the idea that the market generally goes up over time. They're using an example of mutual funds, right? And mutual funds that are actively managed by those managers, as opposed to portfolios. Because if you're looking at efficient market theory and you understand it, you're also looking at Markowitz and Fama and French and all these other guys who've developed different types of portfolios on the efficient market theory curve, which we've covered before. And guys who can get it up there, and portfolio managers like CFPs should be selling those kinds of portfolios, right? If you're selling one of those, they're less risk, and over longer periods of time, they tend to do better than the market because they're lower risk. Because when the markets tank, you don't lose as much money. And it's harder to make money back after you lost it than it is to just not lose it in the first place, right? So they're kind of, as for I know Brian Preston, I think what's it called? Abound Wealth, something is the name of his firm that he owns. If you go to their website, you can sign up as a client. You have to have at least $500,000 to invest. And then you can sign up as, for a meeting and become a client. But then why would I pay him money to invest my $500,000 if his advice is just put it in the market in an index fund? So he's talking at it. They're talking at it two sides of it. Yeah. Why am I giving you 1% of my money? Right.
I could buy an index fund really well. I'm an expert at it now.
Yeah.
Blindfolded in my sleep, 3 a.m. Whatever.
Yeah, and they're super easy to pick. But that's my point. Is it's weird that they're saying, "Well, just be the market." It's like, well, if that's all you're doing, then what good are you? I mean, I just thought it was an odd.
I don't know. It is odd, but maybe the idea is they don't want people picking random stuff they don't understand.
Sure.
They might be suggesting that if people want to get any more complex than indexing, etc., that they need to utilize a professional, but they don't really say that.
No, that's the problem, is they don't ever say that. And they kind of don't go into the concept behind it. They just sort of skip over it. But it's like, yeah, I mean, ideally you'd rather be investing than speculating. Sure. That's fair. Over the long run, that's what you'd rather be doing.